Our next session is titled A Conversation with 𝗕𝗴𝗴𝗲𝗏, author of 𝗕𝗴𝗴𝗏𝗏. To begin this, I would like to invite the moderator for this session, Professor 𝗕𝗴𝗏𝗁𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏 Gurugram, where he teaches two popular papers on behavioral finance and business valuation, and forensic accounting and corporate governance. Sanjay is also managing partner at ValueQuest Capital LLP, a SEBI registered investment advisor, which advises its onshore and offshore clients on their public market investment in India. Professor 𝗔𝗂𝗁, the floor is yours.
Thank you, Chairperson Abhishek Lunkar, for that introduction. I'm very happy that my friend Chris has agreed to join us today from the US. Let me introduce Chris. So I met him a few years ago in Omaha, and I really enjoyed interacting with him then, and I've learned so much from him, from his books, from his blog, and from his tweets. So Chris is a portfolio manager and co-founder of Woodlock House Family Capital. Before starting Woodlock House in January 2019, Chris worked with Bonner and Partners and the Bonner Family Office. He was the editor of Capital and Crisis, published by Agora Financial from 2005 till 2015. He was a corporate banker from 1994 to 2004 and graduated with a degree in finance from the University of Maryland, and he also has an MBA from the same institution. Now, one of the things about Chris that I really love is that he is a prolific writer. So he's written 4 books. I have read 2 of those books. And he's written a book called Invest Like a Deal Maker, Secrets of a Former Banking Insider in 2008. He wrote World Right Side Up, Investing Across 6 Continents in 2012. He wrote the book that he's most famous for, 100 Baggers, Stocks That Return 100 to 1 and How to Find Them in 2015. And the Kindle edition of that book came out last year. I really urge all of you who are watching this to get that book and read it. And then he also wrote in 2018 a very different book, completely different from what I've seen in the past from him. He wrote How Do You Know? A Guide to Thinking Clearly About Wall Street, Investing, and Life. So Chris, welcome aboard. We're very happy to have you here.
Well, thank you, Sanjay. It's good to be with you, and thank you for taking the time here. And thank you to the CFA Society of India for inviting me. Pleasure to be here.
Thank you, Chris. So I'll jump right in. So, I've basically broken up this conversation into 4 buckets. So I'm going to ask you some questions about the latest book that you wrote in 2018, which is a book which I think should get a lot more coverage than it has. And I think it's got some really, really thought-provoking ideas. Then I'll ask you some questions on your famous book, 100 Baggers. I'll ask you some questions about some of the blogs that you've written that I really like. And if time permits, I'll ask you some questions on some of the tweets that you have done over the years. So let's jump right in.
All right, sounds good.
Thanks. About the book, how do you know? It's a very thought-provoking book. I really enjoyed reading it. The last 3 days, I've been just
Thank you.
Reading it over and over again. And there are lots of ideas that I want to talk to you about from that book. You write that investing and life is full of tricks and illusions based on little more than word magic, or nothing more than abstractions, words and symbols that have no basis in the world out there. We make them up.
Right.
They exist in our heads only, and yet we come to treat them as if they were real. You write that we use these words to indulge in what you call as magical thinking, to make stories in our heads. They're unreal, but we treat them as real. I mean, it reminds me of the chapter on narrative fallacy in one of Nassim Taleb's book. When I read this,
Yeah.
it also reminded me of what Yuval Harari writes in his book 𝗕aPiens, and he talks about it in his wonderful course on YouTube based on that book. And he says, and he uses the term imagined realities. He says that there are these stories or myths or imagined realities that are the reason why humans have become one of the most dominant species on the planet. He calls a company as an imagined reality because it's not something that you can touch and feel. It's an artificial creation. He calls capitalism, money, religion, nations, and even human rights as imagined realities.
Right.
But he also goes on to argue that these myths allow us to cooperate in sizes that is not possible in other species, which is the reason why we have become what we have become. So my question to you is basically that you have, on one hand, been very skeptical about labels like growth and value. I know one thing which I clearly got from the book that you wrote recently is that you just don't like these labels.
Yeah.
You write that one man's growth stock is another man's value stock. And you think that these are all imagined realities, in a sense, if you use the terminology of Harari. You say that people create these categories and labels and they're merely meaningless.
Yeah.
But are all these labels useless? Which ones are useful and which ones are useless in your view?
Right. Well, that's a great question. And that's, I mean, you're right. That book is very different from the other books I've written. It's more of a book about thinking and more of providing critical thinking tools. And one of those is definitely around how we think about and how we treat labels. So I think in finance, investors particularly are prone to being overly, let's say, enthusiastic about labels or trusting them more than they should. And you mentioned this, the growth versus value distinction. That's a classic one. To me, that is really a rather completely arbitrary and meaningless label. And people will label certain stocks growth stocks and certain stocks value stocks, and they plot the value versus growth. But really, I mean, they're very, very arbitrary. And certain stocks included as growth stocks are also value stocks, and vice versa. Or they, depending on what kind of criteria you use. And value is not necessarily something that's objective. This is what the harm of using these labels or relying on them can lead you to believe that somehow value is an objective quality that's out there. And value is really inherent in the people doing the evaluating. And so that's why, one stock could be valued to somebody else and could be growth and vice versa. And I think the labels come out in other ways, in the way we talk about even the economy. People will say something like, well, it's good for the economy. But, what does that mean, really? What does it mean? What is the economy? It's not like it's something, I like to say, it's not like it's an animal somewhere in the backyard that we can just go and test and, oh, well, yeah, he's doing better today than he was yesterday. It's more, I think it's helpful to think about those things and break them down. And something's not good for the economy necessarily. It's good for specific industries and businesses. It's not good for certain other businesses and industries. And if you keep thinking that way and breaking down your labels, I think you can get some interesting and creative insight. So maybe it's overly harsh or too difficult to get people to drop their labels entirely, because as you mentioned, they also allow us to think about the world in certain big picture ways that would be impossible without the labels. But I think what I really am pushing in the book is to get people to kind of break down those labels and think about it. Before one other example I'd like to get to is where you see it also is in ETFs. So there are ETFs that have certain labels. So in the book, I talk about one of my favorites is a travel and entertainment ETF. And most investors, if they just trusted that label and bought that fund, they would think they're getting exposure to entertainment and leisure. That was what it was, entertainment and leisure. But if you look at the actual holdings of the fund, something like 20% of the fund, 25% of the fund was in airlines, which may not necessarily tie into entertainment and leisure. It does, and has McDonald's in there. So, that's just kind of a very blunt instrument. And I think, if you trust those labels, maybe you don't take that second order thinking to break it down and think about it. So that's really where I think that kind of
Got it.
Attention to labels can really help you out.
So tell me, if you extend this discussion to other kinds of labels, categories, for example, there are all sorts of categories when you're doing investing.
Yeah.
Industry categories, there are some businesses which by the very nature happen to be very tough.
Yep.
I mean, airlines is an example. And I know you talked about in your book that even airline industry economics has changed over time, but we'll come to that later. But what I want to ask you is that how important are those labels in your mind when you think like an investor, in the sense that how important is baseline information? If you are investing, I know you argue in your book that I only want to focus on the economics of the business. I really want to look at the business, the people who run that business, their incentives, and I want to think about valuation. But the business is not living in a vacuum, right? It belongs to a category. It could be a category of a very tough industry. It could be the retail industry where the mortality rate is so high, or it could be the airline industry where the mortality rates are so high. And there are all sorts of industries which have very high mortality rates. So do you completely ignore those mortality rates when you think about the business, or you have that in your mind and then you also think about this business, and this business is unique and special and it is not going to die, or it is going to thrive in a very tough environment? How do you put these things together?
No, that's a great question. And that's what you said. The latter part there is exactly right. I mean, you have that in your mind. Okay, there's this base rate that we know that most restaurants turn out to be poor businesses, or most airlines tend to be poor businesses over a full cycle, at least looking backwards. Oil and gas is another category that can be problematic on a base rate probability level. But what happens is then you have that in your mind, but you also know sort of why that is. So, why are airlines bad businesses? Well, because they're so capital intensive, they use a lot of leverage, they don't really have control over their pricing. And so these are elements of a bad business, but you might come across one where that's somewhat different. I'm thinking about oil and gas, because you look at companies that are in the oil and gas business, they're, again, have been bad businesses for a long time. And why they're bad businesses? Because it's very capital intensive and because the price of their product has been going down. But there are certain companies that get that label, being oil and gas producers, that don't share those characteristics. So, for example, there are certain royalty companies where they simply own the property and someone else does the drilling, and then they take a percent of the of whatever's produced, a percent of the revenue. And those kind of businesses, those are wonderful businesses. I mean, as Warren Buffett said, one of the greatest businesses in the world is to get a royalty, right, of someone else's work. So that would be a case where if you just say in your mind, I'm not going to invest in oil and gas businesses because the base rate is poor, then you might not consider that, well, not all the companies in the oil and gas business share the characteristics that make the category a bad category. There are some that are unique in their structure. And so the royalty businesses are interesting. And actually, I have a royalty business in my fund. And the same might be true with airlines, same might be true with restaurants. There might be something special. And so you don't want to just blanket, say no, but you want to be aware that that's a bad base rate, but then think about why it's a bad base rate and what you're looking
Ferrari, at. Right? Because I read about your tweets on Ferrari, and that's a bad business. I mean, the industry is horrible.
Great example. That's a great example. I mean, the auto industry is terrible business, but Ferrari is a wonderful business. I mean, you look at Ferrari, the returns on capital of that business are great. They have, it's a tight supply for the cars. They've got waiting lists of people. They certainly have control over their pricing. They consistently make good margins. I mean, it's capital intensive, but even so, factoring that in, the business makes exceptional returns, and the stock's been great since it's been separated from fiat. So that is another, really wonderful example. If you had just been dismissive and said, well, Ferrari is an auto manufacturer, and I don't want to own auto manufacturers because auto manufacturing is a bad business, you would miss the special qualities of why Ferrari, can withstand that base rate possibility, or go against that probability.
So if I was to reconcile these thoughts, it would be along the following lines: that you're articulating in your book that you don't like this stereotyping stuff, that people think in terms of categories and they have these broad-based judgments on this is the lousy business or this is a lousy industry and therefore I don't want to be part of it. But precisely because of that prejudice, you find opportunities in the sense that the base rate might be lousy. This might be an industry with a high mortality rate or average poor return on capital. But this particular company in that industry is unique. It's different. It's not like the average. And therefore, it makes sense to invest in that precisely because of the prejudice that you see in the market, that the market has a tendency to throw the baby out with the bathwater. And does that figure in your thinking? I mean, do you consciously go out to look for great businesses in lousy industries?
Yes. I mean, I don't know if that I consciously go out and say, well, I want to invest in, great businesses in lousy industries, but I'm aware of that possibility. And there are certainly lousy industries where I know there are certain players that are really great. And so you mentioned Ferrari, that's definitely one. I mentioned the oil and gas royalties, that's definitely another one. You know, I'm thinking there's certainly got to be some others that I can't think of at the moment, but I think there are. That's a good way, because, like you say, the market has a tendency to throw out the baby with the bathwater. So
we have some good airline stocks, right, which have created wealth over the long term.
Yeah, and in March, I remember, you know, everything got thrown out. I remember even when oil went through its crazy crash, you know, all the oil companies got crushed, and you could have picked up, you know, some of the prime royalty companies at really amazing valuations, and all those stocks have more than doubled since, significantly outperforming the rest of the energy sector. So yeah, that's an example where, you know, being aware, paying attention to that, you know, and then waiting, and you can get some really good opportunities when that whole industry goes through some dislocation, and even the best ones are thrown out. I mean, another example I happen to think of is, you know, aerospace. So nobody really wants to have much to do with commercial aviation and aerospace. And then in March, there were some outstanding businesses that went on sale. So, you know, 𝗖𝗵𝗿𝗀𝗁 is another one that gets thrown in that mix of being an aircraft parts supplier, and the stock was hammered, and that gave you an opportunity to pick up a truly great business at good price. And 𝗖𝗵𝗿𝗀 is a company that's been compounding at something like 20% a year since 1990. It's a company that has no debt. It's a company that is in a business that's very difficult to compete. And the other thing is, you know, people will put 𝗖𝗵𝗿𝗀 in the aviation category, even though it's about, you know, half of their revenue and even less of their operating profit comes from that particular segment. They do other things as well. So that's another way where, you know, markets can sometimes simplify using some label, but the actual business is involved in different aspects.
So it's good to say that while you don't like labels, you love the idea that market uses labels.
Yeah, that's right. I don't mind it so much that other people get wedded to their labels when it works in my favor.
That's awesome. Okay, so let me move on to the second part of the book that I really like. You know, in your book, you make these 4 propositions. These are: number 1, our world changes continuously and nothing stays the same. Number 2, no two things are exactly alike. Number 3, observer and observed create what the observer sees. And number 4, we can never know all the details. We always leave things out. Now let's just take the first of these propositions, which is our world changes continuously, nothing stays the same. Now I found it very fascinating because this was something unique. You know, first time I actually read a critique of the famous words of John Templeton, and he said that the 4 most dangerous words in investing are that this time it's different. And I've seen that repeated
right.
over and over and over again. But you really attack that notion. Mm-hmm. And I want you to tell us more about that thought that you had on that.
Yes. Well, in the context of the discussion in the book, I talk a lot about how it's always different because the details always change. You know, there's no episode completely plays out exactly like what happened before. There's always differences. So perhaps, you know, and we had a good example of that recently when we had the crash in March. That was unlike anything we had before. It was different. And, you know, if you said, well, you know, this time, if you would have tried to put that crash in the pattern of past crashes, you would have suspected that it would have taken a long time to get back to high. So, but it, you know, actually got back to high months later. It was it's the fastest recovery of a bear market on record for the S&P 500. So I think people get complacent when they say, well, you know, they just dismiss whatever's happening and will say, oh, well, we've seen this before. You know, every historical event, every event we live through is different from everything that has gone before. There are always differences. And I think one of the messages in the book is that, you know, what you should do is push the opposite of what other people do. So when other people see similarities, you see differences. And when other people see differences, you see similarities. You know, you always want to kind of balance that out because they're both useful ways to look at the world, and they give you creative insights if you find ways that things are different when other people are saying, no, this is the same as what's gone on before.
Well, that's fascinating because I'm struggling with this because one of the things that I want to talk to you about is the idea of pattern recognition. And, you know, any field of expertise, we find people think in terms of patterns, and Buffett and Munger and all the guys that we follow, they talk about patterns and failure patterns and success patterns. And
Yeah.
there are many ways of making money. There are only a few ways of losing it. All of that, all I want to know where I'm going to die, so I never go there. So all that stuff
Right.
that we know so well. So on one hand, you're saying that, well, I don't believe in the idea that this time is different, because it's always different. Every situation is different from the previous one. And that will be true. If you go really deep down and look at differences, you will always find them. But
Right.
at a higher level, would you not see similarities? Would you not think about questions like, I've seen this before, or the things that I'm seeing remind me of something that happened in the past, which is quite similar, and therefore I can draw some conclusions about that historical situation, and I know this won't end well, and so on. So
Right.
how do you reconcile these things? How do you rely on history? Does history repeat? It may not exactly repeat, but there are patterns out there, right? So
Yeah, there are definitely patterns. I think that, there are good patterns, there are bad patterns, and sometimes, even with the best patterns. So one of my favorite patterns, for example, pattern recognition, is I love to invest in companies where we have an entrepreneur that has a significant stake in the business. So, there's all kinds of academic research that supports this idea that owner-operated businesses outperform compared to their non-operated peer, where you have a CEO that doesn't own any stock and simply, is a hired hand and has stock options. And so that's a pretty interesting, say, historical pattern that I like to look for. But at the same time, you don't want to get too lazy about it. So I start, okay, maybe at the high level, I have these owner-operated companies I like, but I also want to remember that they're not all the same. There are also bad owner-operators. There are also businesses where the insider owns quite a bit of stock and he takes advantage of minority shareholders, or, and does things to, self-aggrandizement, to, paying himself a lot of money and that kind of thing. So I don't know that it's exclusive either or, but it's being careful about those kinds of things and just assuming that, this looks a lot like what before. So maybe I take a deeper look, but at the same time, I want to remind myself, hey, those two situations are exactly alike, and this may turn out very differently. So we see this in the market all the time, Sanjay, where people will say, well, this is the next Berkshire Hathaway, right? Or people say, this is the next, next Warren Buffett, or is it really? I mean, there might be some pattern to it, but it rarely plays out that way.
Okay, the one thing which I really loved in the book is that you talk about a trick, which is called the dating trick. And I want you to explain that when you talk about this point that you made in this proposition that the world is changing continuously. So how do you use that trick to help you remember this is not the same thing?
Yeah, it's a very simple idea, and it comes from a man named Alfred 𝗕𝗴𝗃𝗁, who he was I guess you call a philosopher thinker in the 1920s and 30s and 40s and 50s in the US. And he wrote a couple of different books on creative thinking. Actually, the light blue books here behind me are his books. And yes, that's difficult to read, so I don't necessarily want to recommend it. It's difficult reading, but it's very technical and whatnot. But one of the things he has is this idea of using a date, and I really like it, and I use it myself in my own journals. For example, I keep an investment journal where I write almost every day about what I'm thinking or what I'm observing about different things. And the idea of a date is that whatever idea you have, you date it. So let's say I come to the conclusion that Berkshire Hathaway is a cheap stock today. So I put in there January 2021, just a date. And this has a couple of different effects. One is it makes it so that I'm not wed to that idea. I know that I had this idea, but I had it in January 2021, and it may be that in June I think completely different about it. And so I don't feel like I have to own that idea. That's what I thought at that point in time, but later I'm free to think of something completely different. And you can do this with anything. So the way you think about a company, you could put a date by it. Vivendi. Let's say I used in the book Vivendi because there was an example where I was talking to another money manager, and he had an idea about Vivendi, and he told me some things about Vivendi, but it was clearly an outdated view of Vivendi. It was a view that had been, he had looked at it more than a year ago, but in his mind, it was still that Vivendi. And I think if you use the dating system, you say, well, you're more conscious to say, yeah, well, Vivendi, when I looked at it in 2018 or whatever it is, this is what I thought, but I don't know what it is now. And that's a simple tool, but I think it's very helpful for me to keep straight that certain ideas and views are only point in time views, and that I'm free to change them, and that they should be treated as a point in time viewpoints.
For people who've been in investing for a while, people, I think they carry some baggage. I have a personal experience to share with you, which is that there were certain business groups that I avoided in the early part of my journey because I thought that they were doing things that were contrary to the interests of the minority shareholders. And that impression lingered on, and it remained for a long, long time. And I would look at those companies, but along the way, the business, the founder of the business retired, and he handed over his company to a son, and the son had studied in the US, and he knew about governance, and he knew how the market cap of the company could be improved if you were to run it in the interest of the shareholders and so on. And all that happened, and I completely ignored all that because I didn't do the date thing. So the impressions that I had were old impressions, and they sort of lingered on. And it's very hard to erase these things. So in a sense, does it make sense to have a clean slate, younger generation of investors, my students, for example, when they look at the same company, they would regard it as an outstanding business. But I had this old impression of poor governance, which is still lingering on in the head. So how do you think about it?
I think that's a great story. And I think, thank you for sharing it. I mean, that's a great story. And that's exactly what happens. And, I'm guilty of it too. I mean, I wrote this book, but it doesn't mean I'm 100%, practitioner of it all the time. I make the same mistakes. I have impressions of businesses that linger, and I just stay away. So it reminds me that, the way Warren Buffett saw the change in railroad stocks. Remember, he bought railroads, and railroads before that time had this reputation of being poor businesses, but he saw how it had changed. And that was a very successful investment. And there's been other times where he's bought a business that was at some inflection point. So those are important to keep, your opinions. If you have the opinion, remember that that's an old opinion, and then maybe it's worth another look. The other thing that's interesting that I want to point out about the owner operator example is that I have found that it is not something that necessarily translates across cultures. So, there's lots of family-owned businesses throughout Asia, but there's not it's a different mentality. They run those businesses for themselves, and they do routinely mistreat minority shareholders. So, it's really and in India, I'm sure culture is different there as well. You have companies that are family run, and they're not all running it, for the minority shareholders as well. And in the U.S., we have the examples of that too. But I think in the U.S. in general, and that's the academic research comes in that has supported the idea that owner-operated businesses outperform, but it may not be true in other markets and in other cultures. So it's something where you all have to take those into account.
Sorry, I interrupted you.
No, it's good.
In India, we have a few examples of outstanding performance delivered by hired hands who had the right incentives, and these people were hired and given a charge of the companies, and they had the right financial incentives, and the founders, they stepped back because they were busy on the golf course and whatnot. Right. They have created enormous value. In fact, I see a lot of this happening in Indian family-owned businesses when the founders realize that there are these other people who can maybe do a better job of running the company, and they actually hand over, virtually abdicating in some situations.
Yes.
And
this is almost an example of the opposite, right? This is an example where people might say, well, it's a hired hand CEO, I don't want to mess with it. But actually, there have been, as you say, some very talented hired hands that also, with the right incentives, definitely. I mean, I've seen that as well, where you have people and that's hard to get the incentives right, but obviously it can happen. I mean, even you look at some of the big tech giants today, look at, Tim Cook at Apple is not Steve Jobs, but look at the enormous value creation that has happened under his watch. So again, you don't want to get too wedded to any particular label.
Yeah. Now I want to go back. I mean, I'm still not done with this point because I think it's very, very important. You said that things change. I want to ask you, what has changed in you? You wrote this book in 2015, not this one. I'm talking about the 100 Baggers one, which was the bestseller, and it's still a fabulous book. But I want to ask you that if you were to write that book again, what would be different? how we changed from 2015 till 2021. What's the difference
Yeah,
between CM2015 and CM2021?
Yeah, I mean, it's that's an interesting question because I have changed and learned a lot. So if I had to rewrite the book today, I think there's a couple of things. It might be changes in emphasis. I think I would emphasize more the idea that you want to own businesses that generate high returns on capital in some way. So, return on invested capital is one ratio, return on capital employed, return on equity, there's the return on assets, so something. And whatever ratio you use kind of has to be what's appropriate for that business. But some kind of return on capital metric, that's really number one. And then number two, really emphasize this idea of having the ability to reinvest. And that's also very important. So it's not just that a business earns a 25% return on its capital every year. What really will help it, what will really make it compound, is if it can take that profit, as much as that profit as possible, reinvest it in the business and earn that 25% again, and then do it again and again and again. And that's really where you get these super compounders, so I would emphasize that more often, because that's a good model and that covers quite a bit of the 100 baggers. Not all of them, there are always exceptions. And I know we may talk about different ways to get there as well, but that seems to cover a lot. And those are two of the most important things. And there's some interesting deductions from that too, because for example, then it makes this idea that you want to have dividends less attractive. I know there are quite a number of investors who want that dividend, but when you think about this model of compounding, return on capital and then reinvesting, you don't want the company then to pay out half of its earnings, as a dividend to you. That it may still be a good investment, still may work out fine, but ideally, you want it to take as much of that money as possible and reinvest it. If they're paying you a dividend, then that's less money they have to compound.
Right. Now, you mentioned return on capital, and of course, it's the internal compound interest formula inside a business. I want to talk a little bit about that. And of course, there are two parts to it. There's the numerator part, which if we start talking, we can go on for days, the earnings part of it. So let's not go there. I want to focus on the denominator part, what's the capital? How do you measure the capital? And I have a couple of questions for you on that. One is that there are all these intangibles. We know that there are these great businesses which have, let's say, intellectual property, or they have brands which allow them to earn superior returns on capital, return on tangible capital. They have pricing power and so on and so forth. But at the end of the day, that brand value is not on the balance sheet, right? So there's an accounting issue here, and modern accounting, as you know, doesn't take care of these things. So how do you actually think about capital? Is it not right to say that the capital is there, it's just that it's not tangible capital? So what is the actual ROCE of a business if you were to incorporate the value of intangible capital also?
Yeah, this is a very good and kind of a philosophical question about what's capital of a business. And so, the idea is you want to try to get a sense for the capital that the business actually deploys or has spent, and you want to try to get some sense for return on that. So intangibles yeah, exactly. So Ferrari, for example, has built this brand. I mean, what is the value of Ferrari, the brand itself? But I wouldn't include that as the capital base, because they haven't necessarily, it comes out as a process of what they've done. They've spent money and they've generated the return that way. So I wouldn't make some estimate for what Ferrari brand is and plop that down in capital and get your return that way. I wouldn't do that. But, there are other tricky scenarios, like what do you do with a company that then is an acquirer of other businesses? Because in that case, you do have a lot of intangibles on the balance sheet. And then if you're making a comparison to that company with a company that has done it all organically and internally, you're going to get distorted returns, even though the acquirer might be as good a business. So in that case, you have to think about both things. I have companies that are serial acquirers, and I track both things. So I take out kind of the intangibles and try to just get a core of what the core businesses do. But I also include that to get a sense for how well they are acquiring other businesses. Those are two complicated things. Another thing that comes up sometimes is what do you do with businesses that have a lot of, say, free working capital, that, and usually you deduct that off, if some businesses are able to operate because they have generous terms from their suppliers, and they might have 30 days of free capital in there. So then in that case, you want to deduct it, and there's different ways to think about that.
Yeah.
So, I mean, I think this question is a great question. Like you said, we could probably talk for days, but just from a more philosophical standpoint, you want to try to get some sense for the money that's been invested in that business, what's been the return off that, and kind of let that be your philosophical guide as you think about it.
So you said something which is important, which is money in the business. Now I have a question for you. Money in the business is not the same as money in the company. So when you talk about return on invested capital, we are talking about money employed in the business, which is generating those returns. So that's the core ROCE of the business. But sometimes businesses are sitting on excess cash. It's lying there, and in the world that we live today, that cash doesn't earn anything.
That's right.
It pulls down the ROCE of the company. But you're buying the stock in the company. So should you think in terms of ROCE of the company, or should you think about the ROCE of the business where you remove the excess cash in the
I think you have to look at both. And I think that's an important part of the underwriting you do in the company. You have to think about, well, what are they going to do with the cash? What historically have they done with the cash? If it's just sitting there and continues to pile up year after year, then that's pretty unattractive. But some companies are, let's say, very good capital allocators, or have a good history of capital allocation, and they at periodic times will deploy that cash opportunistically, and the reward then is makes it worth holding. So there's some companies I don't worry about. I see them piling up cash. I don't worry about it. I know that they will, at some point, they have a history of buying back stock, or they have a history of occasionally, maybe they pay a special dividend, or they do occasionally will buy another company. And there's other ways to use capital and distinguish themselves. But there are some companies, like you mentioned, where they just sit on it. And, there are a number of Japanese companies that come to mind where there's this, perhaps a cultural thing there, where companies just sit on tremendous amounts of cash, and it drags down the returns on those equities. I'm not interested in owning those, So yeah, I agree with your point. Definitely you have to consider a difference between what cash is really required to run the business and what cash is just sitting there at the company level.
But sometimes the cash is there for defensive reasons also, right? Because if you are in an industry which is quite volatile,
very cyclical, yeah.
So you're sitting, and the other guys are not sitting on that cash. They have more leverage on the balance sheet, and they are more vulnerable. So just by having that cash itself makes you safer and anti-fragile, right? So in that sense, the cash on the balance sheet may pull down the ROCE of the business, but it adds to the attractiveness of the overall situation simply because it makes you anti-fragile. Do you agree with that?
I definitely agree with that. I mean, there's a little bit of a tension there, and a company that runs at a very high, let's say ROIC, is also a company perhaps that doesn't have quite the financial resources. So you're making trade-offs. I'll happily take a company that earns a somewhat less than top ROIC, trading off because the company I have has a debt-free balance sheet and carries a little extra cash around, for cycles. I'll happily make that trade. And there are a couple of companies I can think of in my portfolio today where perhaps you could make the argument that they could run it with more leverage and less cash, but I'm happy that they don't. And they still earn a good return even with all that in. It's just not as good as they could.
Yep.
But to your point, it makes it a safer holding through different cycles, and stuff happens. You just never know. And we just had a great example in March with the pandemic. I mean, who could have predicted that? So it's definitely worth it to carry a little extra.
Talk a little bit more, because a lot of people who read your book would say, well, I want to invest in a business which has got very high ROCE and has reinvestment opportunities. And therefore, they might reject a business with a lower ROCE, even though it might be several times the bond yields or passive returns of capital available elsewhere. My question to you is that from a qualitative standpoint, is it not true that you could always boost your ROCE by reducing the denominator in all sorts of ways? For example, by having zero slack in the system, your supply chains, you have just-in-time inventory. So everything works fine until one day it doesn't work. Don't have inventory to send to your customer, or you screw your customers and force them to pay upfront when even if there are competitors out there who could give better terms. So you can always jack up your ROCE. So if the incentives of the managers are to boost ROCE, then there are all sorts of ways in which they can do that, right? They can definitely payments to the vendors, and they can reduce the working capital in the business. It can piss them off and have other consequences later on. But how do you balance the trade-off between efficiency, which is high ROCE, versus longevity of the business?
Yeah, I mean, this is a great question. I think about this a lot because the way I think of it, it's almost like it's a sliding scale. So you have the top ROIC, and then it kind of, as a scatter plot, they kind of come down. And I'm not necessarily, always going for the companies that have the highest ROIC just because of what you said. Some of those companies are running very tight. Also, valuation comes into play. Sometimes those kind of companies can be extremely richly valued because everything's going well, right? That's another thing. You get a high ROIC for several years because everything's going great, and sometimes you might be better off buying something. Okay, well, it's not so great at the moment, but it's going to get better, or, there's other ways that this comes into play. So this is something more where it's a little bit of, I would say, your preference or tastes. For me, I tend to be a little more on the conservative end. So I'm happy to make those trade-offs that we talked about, where I'm taking something where maybe I'm not getting the absolute highest ROIC I could get, but, I have a family-owned business with a great balance sheet, and I trust the people running it, that they're going to make, good decisions with it, and they're not doing things like you are suggesting, where they're just trying to, pump up to get to a certain number and get paid. So you can never really underwrite a company on one number or one factor. You have the high ROIC and you have reinvestment opportunities. That's great. Then what else do you look at? And even 100 baggers, I talk about some of the other things to look at. Having a good balance sheet is important, because sometimes some of these great businesses, they get in trouble when they have too much leverage. The owner-operator thing is preferred only because, again, at least that gets you thinking about the incentives of management and sort of the integrity of the people you're dealing with. So that's sort of another layer. And so you layer on these other things, and then you hopefully will get to a good investment. But you're definitely right to point out the pitfalls of just focusing on high ROIC and investment opportunities to the exclusion of some of these other factors.
Right. In a sense, would it be right to say that apart from high ROCE, what is more important is the spread between ROCE and whatever you think is the cost of capital, and the amount of money you can throw at that spread? And the spread may be small, but if you could throw a lot of money at it, the benefit is that you'll get the upside in terms of compounding that will come anyway.
Yeah, there's that. That's one factor. Definitely. I think another factor to consider is kind of maybe think about predictability. Certain high ROIC businesses are just like every year, there's a narrow band of variability, and some other businesses are up and down, or some businesses face different competitive threats. So it's not only the number itself and what it's been for the last couple of years, but qualitatively, we have to think about how sustainable it is. Those are important questions.
Okay, that's wonderful. Okay, let's move on to your next, the best-selling book, which is 100 Baggers. And there are so many things to observe when you read that book. And it's not, the first guy who talked about it. As you mentioned, you've been inspired by other authors, including a book with a similar name by Thomas Phelps. My question to you is that, well, the formula for long-term compounding is well known. You have a high ROCE business, and you have reinvestment opportunities. You have an owner-oriented manager who's running it with the right incentives. Could be an owner-operator, could be a hired hand, does not matter. And then you give it time. You just sit back and you see that happen, and you will end up with a 10x, 20x, 30x.
Yeah, I kind of like to say it's like a math problem, right? If you do 20% a year, 25 years, you're a 100 bagger. That's it.
Yeah, that's it. But it's not that's it, right? Because
no. Yeah. Oh, I wish it was that easy, Sanjay, please.
My question is that there are all these enemies that sort of, it's almost as if the world is conspiring against you from making and keeping this money. And there are all these things, enemies that are inside, that are internal to the investor, and then there are these external ones. And the internal ones could be things like, it's doubled or it's trebled. So it's gone up too much, or it's gone up too much too quickly. Or it could be that it has become such a large part of my portfolio and I have to think about risk management. Or it could be that there's a bear market coming, or the market is overvalued. I own a great company, but should I continue to own a great business in an expensive market?
Yeah.
Or there's a pandemic going on and the earnings are going to get destroyed, and there is a great depression coming and I need to get out of equities. Or the PE has gone up so much, and therefore and there is something cheaper. I can always replace the high PE stock with a low PE. These are all the kind of things that basically, if people use them, they will not make that 100x or 20x or 50x or whatever the number is, right?
Yeah.
Similarly, you have these external developments which are specific to the company. The business made a mistake, right?
Yeah.
Or the industry is facing a downturn, or they had a couple of lousy quarters, or there are some regulatory risk or some competitive pressures that are coming up. My question is, you studied 100 baggers, you studied businesses that have gone through over a period of 10, 15, 20, 30, 40 years, they've managed to create so much wealth. Did you find even a single one where these enemies were not there, these external developments were not there? Was there a business which had never had a problem in terms of fundamentals, or did they not have management mistakes, or did they not face a downturn in the industry? Did they not have regulatory headwinds or some such?
No, I can't think of one at all. In fact, as I like to point out, that Berkshire Hathaway was the top performing stock in the study, and even that stock was cut in half 3 different times.
Yeah.
So even some of the best performing stocks had tremendous drawdowns, and there was always a stretch somewhere where they faced some sort of challenge. American Express had a serious challenge where Buffett bought a whole bunch of it. I mean, again and again, I can think of where there was some sort of challenge. So the part, you're absolutely right. I mean, as far as the company goes, they all face some sort of challenge at some point.
They do, but you mentioned that in your book multiple times. You give an example. You quote Nick Sleep, and he said that very few things really mattered. And investors must have focused on all kinds of things that didn't matter over the long haul. My question to you is that while we know that the journey from 1 to 100 will have many, roller coaster periods when the stock could drop 50, 60, 70, sometimes even 80%, and there are examples of that in your book. But when that's happening, when your stock is down 80%, how are you supposed to think?
How
do you know?
Well, this is what I think is the most difficult. Yeah, this is why I think this is the most difficult part of the whole 100 bagger teaching is the holding on. That's the hardest part. And it's not only the internal stuff where you're talking about with the problems with the companies. I think those are the most challenging ones. So there's the external stuff too you mentioned, and I just want to also say about that is that you're absolutely right. The whole financial industry seems to conspire against holding anything for a long period of time because there's always new ideas. Everyone's always pushing something you should do, something new, and the narratives are always shifting, and whatever's in the news at the moment seems so important. That's there's this idea called the focusing illusion, which is this whatever you're looking at and thinking at the time has an outsized importance in your mind. And so being cognizant that is a factor can help you. But there's all these things. I mean, this is why more people don't have 100 baggers, is because of these challenges. And in the book, I have a couple.
You're trying to do this in your fund. You're trying to do this as your part of your investment philosophy. I'm asking you, help the audience think through situations where that this is noise and I should ignore it when something like that is happening. That this is not. How do you make that distinction? Can you give at least one example of a situation like that? Maybe something that happened in March 2020.
Yeah, I mean, something like, you can think about, some of the great companies that I mentioned, like HEICO or let's take a different example. It would be interesting. Like I'm thinking of Copart as a company that was about cut in half. But if you take a step back and you think about what Copart is, what it does, and what Copart does is In the US, if your car is totaled, the insurance company gets the car. If it's kind of an accident or whatever, it could be a flood, a hurricane, whatever it is that totals the car, what happens to the car? And the odds are it winds up on a Copart lot, and then Copart sells it on its online marketplace. That's the fundamentals of the business. It's a necessary service for the insurance companies. And that the company itself is one that does not have debt. So that it's not going to face the company itself is not going to face any kind of impairment. So, one way to think through this, as you're saying, is to keep the stock price and the company separate. Remember what the company does and why it's important. And, Copart, you just think about it. Well, there's people that's going to get in accidents still. There's still going to be cars that are totaled. This is something that's going to continue to happen. It's a necessary needed service. This was part of the thesis when you bought the stock, when I bought the stock. And that helps you see through them. But, I'm not going to say that it's easy and sit here and say, well, this is what you have to do in those situations and you'll get through them, because it's not easy when you're going through it. It's very, very hard, especially when you're a professional investor and you have people judging you on your quarterly returns and you're sitting on this stock that's been cut in half or worse. People are going to naturally question, what are you doing? So that's difficult. In some ways, I think individual investors have an advantage in this particular case because they don't have that pressure. It's just yourself, and it's easier to. I don't know if you want to talk about the coffee can, but it's an idea for individual investors where I always tell people to set up a separate account and put 10 stocks in there. That's your coffee can portfolio, and you leave it alone for 10 years and see what happens. But there are ways to try to discipline yourself to get through those periods you're talking about when stocks are cut in half or worse. It's very, very difficult to hold on to. And there's no other easy way other than to stay focused on the company.
So let's take an example. Let me just think of a hypothetical example. Let's talk about commercial real estate. It's March 2020, and the world is apparently going to come to an end. And people are working from home and they're adjusting to the new world. And there are large companies in the US who have told their employees that we want you to work from home permanently.
Yeah.
And now there is a belief going on that you don't need so much commercial real estate anymore. And therefore people will work, technology is there, and we're actually using one of the platforms, Zoom, right now. When that supposing you own a wonderful commercial real estate developer.
Yeah.
And this happens. How do you know at that point of time that this is not going to change? People like working in offices. They will come back. The demand for commercial real estate will come back. If the rents drop, there will be new demand. And so there are both ways of thinking about it, right?
Yeah. So, I think it kind of depends on what you own specifically, because you could own, if you own office properties, sort of like B-rated office properties, then maybe you're in long-term, trouble there. But if you own a company that's still has some of the best office space and, most coveted addresses in different places, maybe that's different. Also, it would depend on leverage. Maybe you've got one that's quite a bit levered and then maybe they can't make it through without raising capital, in which case you have a real impairment or risk of impairment versus one that's better financed.
You wrote in your book that every acre is not the same.
Yeah, that's right. Well, you see this with investors a lot, where they will do some sort of analysis where they take if you have a real estate company and let's say they do a sale, and what investors sometimes will do is they'll take that number and then they'll impute it to the rest of their properties or the rest of their acreage. And that's often a mistake because the variability between the valuation of those different acres can be tremendous. And there was a real life example of that with St. Joe's in Florida, which I wrote about in the book. And I shared the analysis where an professional investor had done this thing where they had taken the sale on some acreage and they'd imputed it to the rest of the acreage to come up with a big value for what they thought St. Joe was worth. And then later someone else came along and said, no, if you look at the drill down at the individual acres, some of them are worth $250,000 an acre and some of them are worth only a few $100s an acre. Yeah. So it really changed the analysis. So that's an excellent point to bring up.
Thanks. I remember in 2017, you actually tweeted something which made me go and read that column. You wrote that good capital allocation by management trumps growth, argues stock picker. You were quoting Miles Johnson in Financial Times, and Johnson wrote a column in which he talked about AutoZone, a company that had, the stock had been up 24x from 2000 till 2013. And I actually went and checked. It's up another 2.4x since then.
Wow.
And the 2000 to 2013 return on 27% was not generated in high growth industry or a high growth company. Rather, they came from a seemingly sleepy business in a low growth sector. During 2000 till 2013, the company's revenues grew at a compounded annual growth rate of only 6%.
Right.
Count rose only 5% a year. Average sales per store by just 1% a year. So we have a situation where high growth rate in the revenue was not the cause of this sort of multi-bagger return, nor was it low PE, by the way. The starting PE was 18x. So what the hell happened? I was very curious. So I found out. Turns out that the earnings per share had grown 22% over this time, and it was driven by operating margin jump from 11% to 19%, and the company going through a crazy buyback. They bought back 73% of their outstanding shares. So a lot of questions come around this. Firstly, this is a sort of to get multi-bagger returns, you need high growth in revenues. So a lot of people don't want to look at slow growing companies or slow growing industries. So this is a very strong disconfirming evidence over there. So the question then is that I don't think you emphasize this in your book so much, because you're early in the 2015 book in 100 Baggers, you're focusing primarily on high growth industries, high growth companies, where the growth is coming from revenues and earnings. In this case, in AutoZone, we are looking at a situation where the focus is not on growth of revenues, but growth in earnings on a per share basis. So the aggregate earnings may not have grown so much. They grew because of the margin expansion, to be sure, but they grew on a per share basis because you retired, 73% of the outstanding equity out there.
Yes.
So what do you think about this? How often do these things happen? What is the right way to think about these things?
No, you're right. It's not emphasized because it's a less common path to get that multi-bagger return, but there are definitely really interesting historical examples. And in the book, I have a whole chapter on buybacks, and AutoZone is one of the great example. There's another great historical example is Teledyne and Henry Singleton, another investor who took advantage of buybacks. But what's so fascinating about AutoZone too is that, as you mentioned, the business did not grow much at all, over that time period. And yet, the stock was up a whole lot because of the earnings per share compounded rapidly because they were buying back so much of their own stock. And so I put that in there because I wanted investors to be aware of this path. So, if you think about 100 Bagger as a peak, a mountain, there are different paths up that mountain. And this is a path that's not as common, not as well known, but it's definitely has been scaled by a number of historical examples. I mean, as like Charlie Munger always says about, he calls them the cannibals. Always pay attention to a cannibal. When you have a company that's consistently devouring chunks of its stock year after year, that is quite a tailwind for earnings per share growth over time. Even relatively modest single-digit numbers can become sizable, by reducing the number of shares outstanding over time. So, it's another, if you will, a kind of a pattern to pay attention to.
So on a philosophical point here, you're looking at a comparison between value creation versus value transfer. So there is this element of zero-sum game here, right? So if you retire 73% of your outstanding equity at a valuation which is low, obviously it's going to boost the value for the other guys. But the real value creation comes from building a business, growing.
That's it. Yeah, because look, IBM today is an example of what can go wrong. They bought back tremendous amounts of stock, and the amount they've spent on buybacks is more than their market cap today. And that's an example where obviously it was a disaster, because what they didn't do is what you're saying is they didn't really grow the business, So this buyback only works if in the future the business itself grows and is worth more. I shouldn't even say it has to grow. We just say it doesn't have to grow that much, but it has to
not shrink.
It has to be still a good business. It doesn't work if you're buying back stock and the business is a melting ice cube, to be extreme.
Okay, that's fascinating. But to the investor, it just feels the same, right? It doesn't make a difference. The stock's going up, so it doesn't matter whether it's a value creation or a value transfer. So there's no point being philosophical about it. Do you agree with that, or you think that?
No, I mean, yeah, I'm okay with it. I understand the philosophical argument that why it would be a zero-sum game and why buybacks. There's this notion when you're talking about is, well, people are just buying back stock. And this is why Buffett doesn't do it. Is partly he's explained, like, it feels like you're kind of taking advantage of your partners. So you're buying them out at low prices, and the guys who stay do better. So yeah, I understand that argument, but like you say, I mean, in this case, the value creation over time, if it works, I'm okay with the buyback formula. I mean, you don't have to sell,
On the checklist of capital allocation skills, there are some people who you regard as great capital allocators, and Henry Singleton is always cited as one of the guys who did that extremely well, because he used his stock as a currency to acquire businesses where he didn't overpay for them, and of course, relatively he paid a very low price because his own currency was so richly priced. And when the stock fell down to a low level, he stopped doing expansion. He actually bought back more than 90% of the stock, and he so-called created so much value. If you look at that example and that of some others that we have looked at just now, and compare that with normal capital allocators, people who actually build businesses, grow businesses, something like what Jeff Bezos has done or what Apple is doing. Of course, Apple has also done a lot of buybacks. But my question is that if you were to look at capital allocation, how do you think about capital allocation skills? How do you evaluate managers on capital allocation? What are the kinds of things? Do you think outsmarting your fellow investors is one of the great capital allocation skills that are desirable, or do you think that it's better to have the other create value?
Well, yeah, I mean, I think it's easier to as an investor, it's easier to buy the business where they have those reinvestment opportunities in the business, because that feels more sure and it's less risky, and they can continue to do that, and there's certain economics of the business that you can get a hold of, and you can follow how they reinvest, and that's easy. The capital allocation part that's difficult involves buybacks, not only buybacks but acquisitions and dividends, how they treat dividends. So a great capital allocator, and how they treat their share count generally. So a great capital allocator, I can think of, they will. So a history of timely buybacks, I think, is one mark of a good capital allocator. You don't want someone who's just buying back stock all the time. But one of the companies that comes to my mind that I own is a company called Brown & Brown. It's a family-owned company, and I remember in December 2018, we had that fourth quarter little meltdown there. They had to put in place a quick special authorization of $100 million and bought back some stock. It was not something they do regularly. It's something they do certain times, and they took advantage, and that turned out to be an excellent purchase. So that would be an example. You see that kind of pattern over time with the same team. That's an example.
Now, acquisitions. How do you connect that example to the other point that you make in your book, that quality of shareholders matters? And you've written about that, the QS factor, the quality of the shareholders. Effectively, when a company goes and buys back stock, it is taking out those guys who are willing to sell, right?
Yeah.
So are they actually improving the quality of the shareholders that remain?
That's an interesting point. I hadn't thought about that. That's, why would they, right? Because right in the middle of a panic, who's selling? It's usually the ones who are not focused on the long term of the business. So in a way, they're sort of increasing the quality of their investor base by taking out the panickers and the people who, like you and I, who sit with it. We stay. So that's a good point. That could very well be. But capital allocation is skills are not common, and Henry Singleton is in a league of his own, and even people that are good capital allocators will still make mistakes. So you have to. That's why I think the reinvestment opportunity is a surer path, but then the capital allocation, every once in a while you find a company where it's like an AutoZone or somebody where it's just ingrained and they manage it. I mean, there are other companies where they're culturally seem to be thoughtful capital allocators because they have a good internal framework for how they think about allocating capital. So it's not really tied to any particular person. It's a process. Think of something like Danaher, which has been a fantastic stock and business for a long time, and depends on acquisitions, but they've been able to do it. they've been able to make these acquisitions time and time and time again, hundreds of acquisitions. Constellation Software is another company cited as a great capital allocator. They've done hundreds of acquisitions over the years that have worked and created a value. And in that case, again, it's maybe not necessarily one person, but it's a process that they've honed and that they've internalized as a company. It's kind of a culture. And those are good opportunities to look for.
Okay, wonderful. Okay, in your book, you have put a chart which is very fascinating, which talks about the average lifespan of a firm in the S&P 500, and it's now less than 20 years. It used to be 61 years, is down to 20 years. And it's estimated that 75% of the current S&P will be replaced by 2027. Given this, and given the popularity of passive investing, where do you think we are headed? The world savings in the equity markets are more and more directed towards indexing. If the money is going into indices, passive money management, then what's going to happen to this whole thing, and how is this going to end? Would you see a bubble in indexing? What are the opportunities for value investors? If the average lifespan is 20 years, then obviously some will last much more than 20 years.
Yeah.
What happens if one of your stocks, which is not in the S&P 500 index, enters the index after you owned it? That's like something like that happened to Tesla recently.
Yeah.
I think it makes sense to predict this kind of a catalyst before you invest or while you're invested in the company.
I mean, as a long-term owner of businesses, I don't care to predict whether a company is going to be put in an index or not. But definitely, you're right. Indexing is here to stay. It's a big factor. And
because I want to ask that this trend that you're seeing, is this a bubble? Is it going to?
I don't think so. I don't think the indexing is a bubble. I think that will. I think it's probably will continue to grow, and then it will get to a point where it sort of stabilizes. So what I mean by that is, I don't know what the number is now. Let's just say it's 45% of assets under management are indexed. Maybe it moves to 50% and then it kind of stabilizes, or maybe it goes to 60 or 75%. I don't know where that equilibrium is eventually, but I suspect there'll be some point at which we reach some kind of equilibrium there. And that
my question is that, is this not good news for you? Because the more the world moves towards indexing, the more of the money is directed towards situations where there is no need to do any analysis. So the competition is reducing, right? From a competition point of view, opportunities that you look for, great companies, compounding machines, owner-operators.
Owner-operators actually tend to be underweight in a lot of these indexes because the indexes are built on a float. And so if you have an insider's own 35% of the stock, it will be underweight in a lot of the indexes, which is kind of counterintuitive to how you would think as an investor. But I think it's a mixed blessing. I mean, it's positive in some ways because there will be companies that get left out of indexes for whatever reason, or I just mentioned the owner-operators where there's a lot of insider ownership will be overlooked. But from a big macro standpoint, it also is a little bit of can be a disadvantage because think about it, the indexed assets have this continuous flux of buying all the time, and you're buying assets that have the opposite. That seem to have this headwind, and so the index is sometimes can be very tough to beat for these stretches of time. But in the end, I think
because if you're managing your own money or your family money,
it doesn't matter. Yeah, it's right. But for some people, it will, and a lot of funds, these big mutual funds and things that depend on that, they'll see outflows. But yeah, I think you're right. I think what you'll have the pockets of active management will be with money, with families or people managing their own money, and who are not necessarily so worried if they're behind an index for a while, but are more interested in kind of picking up the opportunities that we're thinking about or talking about. So yeah, I think it's kind of a mixed.
Okay. So another question I have is about valuation, which I think is, it's interesting because, there are three buckets. There is a business bucket, which is about how is it a good business or not. There is a management bucket, is it a good management or not. And there is this valuation bucket where all the numbers come in. Most of the numbers come in, but it turns out the way I think about it is that the business bucket is actually quite objective. so is the management bucket. But the valuation bucket, paradoxically, is not objective because it's all based on dreams and hopes and
stories and
narratives and abstractions. So I want to ask you how you think about valuation. You found a business, you checked off everything, you love the business, you love the people. Now, obviously, we know that a great business bought at the wrong price turns out to be a lousy investment. So how do you think about valuation?
Yeah. Yeah, this is a very, very good question because and it's hard to answer in some ways because there's no hard and fast rules. Like I would love to say, well, you just buy something where you get a free cash flow yield of 5% and don't pay more than X and Y, but really can't say that. So, for me, it depends on, for me, I usually buy businesses that are, I would say maybe more mature. They're already generating good free cash flow. They already have returns on capital. They have a track record of some kind. A lot of the companies I have been around a while. So in that case, the valuation metrics I tend to think about are free cash flow yield. And free cash flow yield, kind of estimated growth. And, with the 10-year treasury in the US at 1%, suddenly, I find myself paying more for businesses than I might have been willing to pay even 4 or 5 years ago. But it will still work out. The math will still work out if you look out long term. So that's kind of the thing that I think is important. Do
you mean free cash flow or do you mean owner earnings? Because some great businesses would have negative free cash flow.
Yeah, I look at free cash flow.
Reinvestment opportunities, right?
That's what you
look for.
Yeah, so free cash flow, but I guess I should say maybe then what you would call as operating cash flow. So free cash flow before is kind of the discretionary reinvestment and things like that to get a sense for maybe what you're paying. So, but that means I'm missing out on some things. I mean, I'm missing out on some of the businesses that, let's say, I don't know, some of the tech businesses that don't show, like a Roku or something, that don't really show any free cash flow now, but people are buying it obviously with the expectation that it will generate a lot of free cash flow. So certain businesses I'm going to miss, and this is something maybe we should mention because you can't pick all the stocks, you can't get all the winners, you're not going to hit everything, and you have to find an area in the market that you're comfortable with, and then you have to just accept that you're not going to be, there's going to be stocks you miss. So I've created this little formula that I like, that works for me, but it means I'm going to miss certain opportunities, and I'm okay with that. You have to be okay with there are certain things I'm not going to see.
Okay. Is it correct to say that there will always be mistakes, and you have to think about what kind of mistakes you're willing to make? You can end up making mistakes of omission versus the mistakes of commission. Yeah. Now, obviously, if you make mistakes of commission, they show up on your performance numbers. Mistakes of omission don't show up. But do you think it's the right way to think about that? On one dimension it is, but on another dimension, if you bought something and you sold it when it became 2x or 3x and it went down to become 100x, that hurts, right? And
that's the worst.
That's also a mistake of commission, and the money that you did not make that you could have made. You owned it, yes. You sold it too early. How often? Yeah,
this is a very, very painful thing. I mean, there are mistakes of omission. There are things I've looked at that I was thinking about buying, didn't buy, and then they perform very well. And you're going to have those. Everybody does. And it's a business that is humbling, and we make a lot of mistakes. So you have to be comfortable with that, because even the best investors make lots and lots of mistakes, and even mistakes of omission.
Yeah, and that helps, because when you see Warren Buffett buying IBM and talking about it so much.
Yeah, that's right. Yeah, think about, he'd talk about why, some of the business he missed. Why didn't he ever own Google? Why didn't he ever own Amazon? So, and he's one of the best ever. It's like I say, it's a humbling business.
It is, absolutely. I think we run out of time. Time has just flown. It's been such a pleasure, Chris, to have you here. Thank you for coming here and spending your time with us.
Oh, thank you for, spending the time reading all what I've written and coming up with a lot of good and thoughtful questions. I appreciate it. It's a pleasure speaking with you.
Thank you, Chris. And over to you, Abhishek.